this is Dr. T. Vara Lakshmi discussing you about the ledger and the preparation of the ledgers under the business economics and financial analysis. Once a journal is prepared, the second step in the maintaining of the accounting is called as the ledger. So ledger is a separate account for the books of the records which are maintaining under the journal. So whatever they have analyzed or recorded that transactions, that is going to be summarizing with each and every account wise, then it will be called as the journal entries. The pro forma of this one is the title of that ledger, that is the name of the ledger account, let us say cash account, or name of the furniture account, name of the capital account. So like this, each and every factor they are taking into the consideration. Whereas on the left hand side, it is mandatorily taking the debit balance. On the right hand side, it is credit balance. That is the rule of that one. And next thing is, it is a double entry mechanism, means it is a double folded elements. That is date column at debit and date of the credit, particulars, JF number, journal books entry number, and the amount, and here it is the amount. So for example, cash was at debit, so we are preparing the cash account, and this cash is debited to the organization because of this capital. Then that if the cash is at debit side, then the opposite credit amount has to write under the debit side. And the same thing, if the cash is at credit side, the opposite of that purchases has to write under this credit side. So let us say capital is 1 lakh rupees, and the purchases are 1 lakh rupees. Then it is balanced, and the capital is 1 lakh and purchases are 50,000, means the remaining cash at bank should be at 50,000 must be there. That balancing of that one particular element, the cash element, purchase, one particular account of the organization is called as the ledger account. So some of the examples, if we take into consideration bank account, this particular year and the date of that one, on March 2nd, the cash is deposited with the organization 40,000, and the bank loan has issued 20,000, and it is debited 60,000. And in what way it is furniture 5,000 is there, and machinery 2,000 is there. For the XYZ machinery 2,000 they have paid. The remaining balance which is left with the organization will be called as, to balance these two elements, they have to make it as both are all the equal 60,000, but this side 51,000 balance is there. That amount has to carry down to the next date, that is up to March. By the end of that particular month, we have to mention this is the amount balancing here, figure here, and later equalizing the total amounts. Again, we have to write the next date of the month, and balancing brought down amount is 51,000. Here, suppose this side on the credit side, if it is 60,000, on the debit side, if it is 9,000, then we have to write here is balance carried down amount is 50,000, where on the opposite side we have to write as the balance brought down amount is 51,000. So like these opposite sides we have to make those transactions. So if we observe these features of this ledger account, each balance sheet items is given its own page, that is in a T shape. That is, we know that accounting equation, that is assets, liabilities, and ownership. So let us say assets of the bank side, that is on the debit side, this is the balance. Surpluses are all debit sides. All the assets will be having their balance at debit sides, whereas the liabilities will have their balances at carried brought down amounts will be have at left sides, right side position. So that left position will be equivalent to the right side positions. That is called as the T format of these ledger accounts. And here the name of the account is centered and at the top of the one, and the opening rupee figures of the assets are all recorded on the left hand side, that is on the debit side, and the expenditures will be written on the credit side. And both the ledger and the balance sheet displays the financial position of the organization effectively. So some of the examples for this one is T accounts. So always for the assets, it should be on debit side, and always for the liability side and the ownership equity, it is on credit side, because the business organization amount is crediting in the form of these liabilities and the owners. That's why it is on credit side. That amount they're spending for the purchasing of the assets, that's why the balance at the assets side should be at debit side. So the advantages of this ledger is complete information can be known for one account at a glance is possible, and arithmetical accuracy of each and every transactions can easily identify this one, and results of the business operations can be known from this ledger account, and accounting information can easily known or gets from this ledger account. The limitations are all there. The transactions has not been entered at the journal may not identifying under this ledger. A wrong amount which has entered in the journal is also not rectifying in this ledger. Just as a copy of the journal entries with a separate mechanism is called as a ledger account. And these are all like a posting of the one transaction at twice. That is preparation of the ledger. If we see these types of these ledgers are all of three categories: sales ledger, purchases ledger, and the general ledger. If person's accounts, if they take into the consideration, then credit customers related information, that is called as the sales ledger. Purchases ledgers means the suppliers information, if they take into the consideration, purchases ledger. And the general ledger, that is related to every transactions, if they take into the consideration, that is called as general ledger. And the subdivisions are also there for this ledgers, that is general ledgers. Again, if it is living things, if they take into the consideration, personal ledgers, account receivables, account payables. And non-living things like furnitures, if they take into the consideration, they will be called as real ledger, nominal ledger, private ledger, and the cash ledger. Non-living things, if they take into the consideration, that is called as impersonal ledger. But in the general ledger, both will be considered, living things as well as non-living things. Once if we observe the differences between the journal and the ledger, recording is a main activity of the journal. So whereas every transaction should take into consideration. Ledger, they are not doing the recording. They are all transacting. They are all interpreting that one. That is, once it has done, entry has done in the journal, that is only separately taking on account basis in the ledgers. And stage of the recording is first stage is the journal, and the second stage is the ledger. And order of recording, if we see, so the chronological order, that is date wise, they have to mention under the journal, and in the ledger they need not to mention this date wise. So it can be done at the transaction maybe occurred earlier or later. And the process of the recording is called as journalizing, whereas the process of the ledgering is called as the posting. And facilitating preparations of the trial balance are easy with the help of this ledger than the journal. And basic of the entries are all based on the sources of the documents has to record under this journal, but the basis of is not required for the ledger. Once the journal is there, then it is easy to prepare this ledger account. Net position of the accounts cannot be ascertained with this journal, because daily they are writing. One thing is not taking into consideration. In the ledger, they are taking all one separate entity basis, so it is very easy to ascertain the net position of the any element or the transactions of the organization. So that's about the ledger, types of the ledgers in the accountancy. Thank you.
Like, share and subscribe. Hit the bell icon for more updates.